G'day, how you going? Inside Commercial Property, Phil Tarrant here. Co-host with my colleague Scott O'Neill, Director, Founder, Rethink Investing, chatting things all through commercial property on the airwaves of the Property Investment Podcast Network, and also tuning in. Hello to everyone watching us wherever you tune into this, probably on YouTube or elsewhere. Welcome to Inside Commercial Property. We like doing this. It's, regular monthly occurrence where myself and Scott get together. We have a chat about commercial property, and I like to think probably changing people's mindset towards commercial property. We get a lot of feedback. I was only, to be sort of at least a month or so ago now. I was up at the big real estate conference called AREC, the Australian Real Estate Conference, up on the Gold Coast, and I think it was late May by memory, and just visibility. This podcast network has, changing how people think, act, behave, operate around property, and it's nice to know that we are helping people make those changes to the attitudes towards investing in property. Maybe that shift from resi to commercial, and we'll keep going at it. We get a lot of feedback, which is good. We collect that feedback, which is good. And then occasionally we get together and we talk about that feedback, which is good. That's what we're going to do today, Scott. How you going?
Yeah, good, mate. Yeah, thought it'd be good to go through a bunch of the questions that have built up over time. So, yeah, we've had a lot of guests on recently, and they've been really good, really interesting to hear what those guys have to say. But, thought we'd just go back and get into the nitty-gritty of commercial property again.
Yeah, so I actually called up we had a couple of agents fly in a couple of months ago now from Toowoomba and Townsville. By memory, did I get that right?
That's right.
And we had a good chat around those markets, sort of southeast Queensland and Townsville. And I remember chatting with the guys before we come on air around the minister for Townsville, Phil Thompson MP. I actually saw him the other day, and they were telling us a story about a dinner they had with him, and I am happy to confirm that what they said was absolutely correct. He'd only been in the job for a couple of weeks as well, but he's obviously passionate about his location, his area, and and I mentioned that I caught up with I can't remember his name, the agent out of
Sean McLaren.
There we go. Yeah. So all good, and that was good. It was nice to deep dive into areas like that to actually give a real sort of, this is the real deal inside view on a particular area, and Townsville being a place of growth, and we sort of spoke through that. Go back and tune into it. It would probably be, I would imagine, the April installment of Inside Commercial Properties when we did that, which is cool. But if you're tuning in, guys, thanks for coming down again, all the way down to Sydney. I know it's probably a cultural shock to you, but the feedback has been good. It's great. I like doing this, and you must get feedback every day on it, though. How many sort of clients do you catch up with, and they go, "Oh yeah, I listened to this and this, that, and the other."
Yeah, look, this podcast formed a lot of their decision making or their initial interest in commercial property. So, yeah, it's been huge for us and Rethink Investing in general. And yeah, we'd like to position this as just not a sales pitch, just something to have a yak about with all things commercial property. And yeah, it's
is there a sales pitch in for commercial property buyers agents? You don't really have to sell, do you?
No,
people come and find you, don't they?
We've got to remind people the sky's not falling in when it's not. We've got to remind people there's potentially a better asset class. So I guess that's an indirect sales pitch. But we're really just having a chat about the asset class, and we've got opinions on the market, and we do push those as well. So it's never financial advice, but everything we've sort of said's been pretty level, I think, along the whole way. And getting these agents in and talking to, like the guy in last month's one, Michael McIntosh, the farmer, seeing what he's done with his life, and
the whole sort of, and it makes sense. This wealth transition, right? We spoke of that within rural communities, and rural communities being in many ways for hundreds of years the backbone of the Australian economy. The transition of wealth within rural communities, but just someone at some point being smart enough to go, yes, we're farmers and we will continue to farm. However, maybe we should just put our money outside of farming. And the point was, commercial property is a great place for that. It gives you choice and options moving forward. I think it was well considered.
Yeah, exactly. And I read an article, it was a little while ago, actually. It was talking about investors should follow what family offices do. Like this The first family office was the Rockefellers, and obviously now in Australia we've got the Gina Rineharts, the Andrew Forrest, all those kind of guys. And for years they were buying rural land up. But for the last year or two, they've been selling it. So, they say the everyday investor, we're not going to be able to compete with those guys, but follow what they're doing. They tend to know what they're doing as well. So the fact that they got in a long time ago, they bought up most of, northern Australia in some areas. And a lot of them are selling out and now transitioning into different types of assets. And one of those right now is commercial property. Gina Rinehart recently bought a tower in Brisbane, office.
As you do.
Yeah, as you do. Like office to the everyday person seems like a ridiculous idea at the moment. But, follow the money. Who knows?
Well, follow the money and they're fortunate because they make so much dough. They're able to pay the best and brightest people for, 5, 10, 20-year horizons, right? And and that mining game, was it Hancock, to have visions of 50 years into the future. There is some smart people that can help you doing that, but you don't need, if you don't have the money to do it yourself, just follow, to your point, follow what other people are doing, and success leaves clues, right?
Yep.
So,
and they generally beat the market by 3 to 4% as well. So, if everyone's getting 7% in the stock market, they're normally getting 3 or 4 over that on average.
Yeah.
If you look across the thousands of different family offices out there. So, I found that article interesting, and there's a bit about that once you sort of start digging into that.
And you can go and find it, right? But the point is sort of counter-cyclical investing. She must know something other people don't, because you talk about anyone at the moment, anyone at the moment, they'll tell you, the office market as part of commercial is still subdued, without a lot of sort of vision or visibility to the future. But then you look around, we're recording in North Sydney, they're putting up towers left, right, and centre at the moment. So go figure.
Yeah. Look, it's still a strange one. Look, maybe there was a bit of the fact she'd used the office as part of her, Hancock mining office space, housing staff there. But it is very counter-cyclical. There's probably a discount being offered, and compared to some other assets like industrial property, which can be inflated in certain markets, like there is better buying per square metre on a historical basis, at least. Yeah,
and one of the question that's come in today, and we'll get into it, but it's sort of connected in with this, is around REITs, real estate investment trusts. So buying inside of a REIT, whether it's listed or unlisted, or whether it's buying sort of direct property. But you look at the office market, Scott, and you look at the city skyline's changed recently with the Salesforce Tower, right? And you sit there and just scratch your head going, a lot of money's gone into building that thing. It looks okay. Then you look at the AMP buildings have all been redeveloped. They're redoing the smaller one. They've redone the larger one. Like the skyline in Sydney is changing in the office market. So people must be back in the office market. It might not be right away, but they're obviously thinking 10, 20, 30, 40 years in time.
Yeah. Well, look, immigration levels picking up. Yeah, they're going to work in the city, aren't they? So there's greater forces at play that the everyday person doesn't see, and it's probably not a good market for the next few years. But like you said, that long-term horizon, centre of a big city that's growing, it's still going to have value.
Well, the best city in the world to live, allegedly. This is some stuff that came out last month or the other month. But let's kick off. So we'll talk about REITs today, and there's quite a few questions coming in. I'm actually looking at my phone for those who are watching this on video. I'm actually looking at my phone. There's some notes here for once. Normally there's zero notes, but we have some notes. So we'll talk about REITs. We'll talk about questions here around sort of value-adding frameworks. There's questions here around what to do at renewal time. There's questions here around what do you do with vacant properties. There's questions here around innovation. There's questions here about how close you should get to your tenant. So we'll bang through a lot of these today. But there's one point here from someone who hasn't really disclosed themselves: REITs versus self-owned properties, so performance REITs, assets, etc. An area for the podcast. Or if you have any existing thoughts, research share. I was wondering if Scott could cover his thoughts on direct commercial property versus buying a REIT, e.g. Dex's industrial REIT, or an unlisted managed fund, such as Charter Hall Industrial Fund Number 4. He's pretty specific there. We won't talk specifically around any funds at all, but investing in commercial property via a REIT or via doing it yourself. Now, let's be clear. If you've got a superannuation fund, whether it's a retail fund or an industry fund, there's a good chance that you've got exposure to property, commercial property, listed commercial property or even unlisted commercial property. So you would have some exposure to it, but Scott, thoughts?
Well, look, there's a lot to break down there. So interestingly, this market, it's according to the recent statistics, it's a $144 billion industry. So it's quite large. And
In
it's
Australia?
growing in Australia.
Yeah.
But that's broken up. Well, there's actually a lot more than that if you sort of go into the unlisted funds and listed funds. So look, real quickly, a listed fund is transacted or at least traded on the stock exchange.
Yep.
So it's like shares.
So let's go real basic. What is a listed fund? So what is a fund? So let's be visual about this, right? Because people might not understand it. What does it look like? What does it smell like? What's in it? How does it work?
So a listed fund is bought and sold on the stock market. It's like shares in a building or shares in a holding investment trust. So it might have 20 properties in there. So it's like a blended yield. You're going to get the profits out of it. It's very liquid. You can invest lower amounts of money. You don't need to be a sophisticated investor. That's where you got to have either investing 500 grand or earn 250 2 years in a row or have 2.5 net mil in assets or more. So that's what you need to do if you're going in an unlisted fund. So an unlisted fund is a privately held trust. It's generally managed by often the same companies. They can have both, but the listed funds are much larger because they're getting larger volumes of money put into them. They're a lot more liquid. The unlisted ones, they could be an individual property. They've got a responsible manager over it. And the key is there's so many different types. There's thousands of these. It's an old industry. You know, the big companies like Dexus and Centre Group, Westfields, like these guys like Stocklands, they've been around forever. They can develop properties. They do everything from just holding to value adds to office REITs to industrial REITs to retail REITs to blended REITs, regional REITs. You know, they're all out there. So you've got to really pick one that fits with your investment strategy and look at the manager's history and all that kind of stuff. But it's an easy way to get started into commercial if you don't have as much money or you don't know what you're doing and you just want the safety of someone to do it all for you. Now, there's a lot of negatives to do it, and you know, there's a lot of people that won't tell you the negatives because it's a massive industry that tells you all the positives. You know, so and full disclosure, I'm more biased towards direct investing because I've made more money through that, but I have set up trusts multiple times. I've helped investors get into them. I'll be doing it in the future again as well. So I do see the benefits of both, but what the fund managers will not tell you is it's very fee intensive. Like, so you've got, normally it's like an acquisition fee. It could be 1.5%, 2% to purchase. It could be 0.5% or even 1% every year. This is the entire value of the asset every year that you get charged. And that just basically, it gets charged by devaluing your shares in that fund. So it's still a cost to you. And they generally will force you to sell every 5 to 7 years because they make money through selling and they get a performance fee. This all varies between every different fund. Like
Listed and unlisted?
It can be both. Yeah. So there's just so many different variations and rules. So this is a very high level general comment. But you've got to be wary these fees do take away from your profit margins. And
so they take all these fees. So a really, really simple thing. So you have a trust, listed or unlisted. They get a whole bunch of money from people, club it all up. Then they go and buy different assets that live inside this trust. And then that trust, the assets in that trust perform. They provide rent, etc. Then whatever's left of operating costs, etc., gets sliced up. But before it gets sliced up to you, the investor, they take all their fees off it.
That's right.
Then you're left with what's left.
Yeah, and there's normally an overraise component. So, they might have 110% of the money in there, and that kind of accounts for different levels of fees and, if the tenants don't pay all on that month. So there's buffers in place. So that can equate to, let's say you've got it for 5 years, you've got a 2% up front, so 2%, then you might have 5 years of that 0.5% each year. So that's another 2.5%. And then you've got a selling fee and a sales fee, performance fee. Like, it can actually equate to about 8 to 10% in total fees of the total value. So your money gets diminished due to that. When you go by yourself, even if you use a buyer's agent, they're going to be charging like an upfront, 1 or call it 2% fee right up front, but that's it. But then you won't.
I can't remember. What do you guys do? You do an upfront fee. You do a...
We do a fee at settlement, 1.9%. Okay. So it's very similar to the acquisition fee you'll be paying for a REIT.
Yep.
So they all do the same thing.
So that's getting the person getting paid for finding the right asset. Now, you'd like to think inside of a REIT they're finding the right asset. They're putting the right asset, and depending on the REIT, they might have some office stuff in there. They might have some industrial stuff in there. They might have some diversified stuff. So the same applies for a buyer's agent. You're out there buying a fit-for-purpose property on what someone's trying to achieve. Yeah. Acquisition fee.
So the acquisition fee is really to pay for finding the property and the due diligence of it. Yeah. And obviously all the legwork in getting you through to settlement. So there's a bit in it, and you should be doing the same job. So we buy from funds regularly, like selling off their smaller assets more so, because fund managers generally play in the 30 mil space, but they still have $5-10 million assets. So they're the ones we love trying to pick up. Often no agent involved, direct from the fund. They're good to buy from because they've got the due diligence in packs and they've got to report it to their investors. They've got book values where they have internal valuations. See,
this is what I've always found, looking at REITs versus directs. The way, and for the uneducated person, myself included, I call it the skullduggery sometimes you see in trying to lift the value of an asset. You see they're just going, I don't really understand it. That's not really the way it works. And having been on the side as a tenant for commercial transactions, they'll tell you it's $900 a square metre, and that's the value of the property. However, they'll be giving you incentives to get that down to $600 a square metre, right? So the book value of it is $900 a square metre, but realistically it's yielding only at $600 a square metre. So this is where it gets a bit murky for me. But if you have an acceptance and understanding of that, that's okay. You just need to know how it works. I don't think a lot of people actually know how it works.
No, and look, there's a bit of controversy around at the moment, particularly in the office market. Like I read a short snippet of an article that I saw the other day. So with several large industry super funds posting positive returns courtesy of internal valuations, some observers are calling foul, claiming this paints an unfair positive picture on their investment performance in the last financial year. The last financial year has not been great. If you look at the overall stock market, it's down about 6%. But they're still posting values much higher than that.
They're putting their own valuation on it. And commercial assets are valued by how much yield it really generates, right?
Yeah.
So numbers can get a bit rubbery.
Yeah. Yeah. And I just don't, for me personally, like I'm a do-it-yourself investor. I like having full control, and having no control and trusting someone that's got to drive a business profit.
Yeah.
It just
which is what you need, right? I know, but like you need someone, if you're investing in companies, you want to be investing in or REITs or whatever it is that are profitable, right? You don't want to be going backwards. But the point being, and I made it said beforehand, is that most Australians have exposure to this sort of stuff via their super fund. And super funds will do listed REITs and unlisted REITs, right? They'll just buy a whole building themselves and manage it rather than sort of trade or transact on the stock exchange. So most Australians are connected in with this. But I think if you ask the average person on the street who has a super fund, they have no idea how it all works. And it's a mystery, and unless you're really curious to go and find out, you're never going to know. But I think those that run and operate these type of things, and this is not a negative point, but it's like they quite like the idea that is a bit mysterious and no one really knows, right?
Yep.
And that's one of the negatives of the REIT. But there's a lot of positives as well.
Yeah, so the positives are it's liquid. Well, the ones on the stock exchange are liquid.
A lot of the unlisted stuff, you can't get out once you're in.
It's hard. They've got to replace your portion. There's sometimes costs associated with selling. Look, you really got to prepare to just leave your money there and trust it's all going to go well. But you can put less amounts in there. So one of the arguments REIT investors will always say, or not investors, the managers will say, oh, you can't buy good quality property under X amount of dollars. And that's one of the big sales pitches, come and buy the big property with us, the big shopping centre, and it's safer. And it is safer in general because you're protected by more tenants. You've got potentially longer leases, bigger brands. These properties all exist in the cheaper price points, but it takes a lot of skill and luck to find them. So for the everyday punter who spends less than an hour a week on investing, this could be a safer option, unless you outsource it and then you can get the good results by direct ownership. The leveraging factor is probably the main reason I personally see a benefit for direct investing. You can get 60, 65, 70, even 80% loans in commercial property direct investing, and in a REIT, it's 50.
Yeah.
So a lot of them aren't even leveraged that high, which is probably a good thing when you're coming into a downturn, because we all saw what happened in the GFC. All the highly leveraged REITs went under. Some dropped in value by 40%. Some went under. It was a messy period after 2009. But yeah, direct investment, just like residential property, that leveraging component is the greatest multiplier of profit that you can get. You leverage something to 80% and hold it for 20 years, it's hard to go backwards. As long as you meet your cash flow obligations, there is more upside.
Oh yeah, I must admit, direct commercial property, it's pretty easy, right? Like it's a lot more forgiving than residential property. I'll tell you that. As an asset class, it's not as much of a time absorbing issue. I don't. Well, I still have some money in sort of retail super, but I have no direct sort of connected exposure to REITs, whether they're sort of listed or unlisted. Well, I guess I do actually, because a lot of my investing is through trust, right? So they're unlisted trusts. So yeah, I do have a big exposure. It's funny how you frame it, but it's horses for courses. I guess people are going to go to you, Scott. Well, of course you're going to say, invest directly rather than a REIT because that's the game that you're in.
Yeah.
But so whether there's a bias there, I don't know, mate.
There is a bias, but again, I've set these up, and I will be setting up another one, like even just a feeder fund, so when people are waiting for a property, they might get exposure to return. So there is benefit when you have a liquid fund because you're getting a return on money, but you can't compare it long-term to a direct ownership. Like even in my own portfolio, I've been getting 35% average returns since I started, and if you look at the returns on the unlisted funds, they're well under half that. And we're still buying the same stuff, getting the same yields. It's the leveraging difference and the fees.
So how much of last year have you copped on that 35? How you get that now with all these interest? Because I know you're leveraged. So.
Yeah, I reckon last year my portfolio's gone backwards about 6 or 7% overall.
So it's gone backwards in terms of its capital value.
Yeah, and then the rents have gone up about 4% on average. So there's been a bit of a buffering in that department. But
you don't dwell too much. You just go, well, this too will pass, right? It's a moment in time.
The biggest impact of the last year is the cash flow, which everyone who owns property has that. So yeah, the income is lower, and I guess what people must realise is when you have interest rates go up, that actually is going to create a long-term benefit for you because the rents are going to go up for a higher amount for a longer period of time. And there's a few reasons for that. People build less. People push their tenants up in value more. You're more ruthless on a lease negotiation because you have to, and you feel like you've been hard done by on the interest. But the net effect is there's just less stock. There's more tenants that haven't bought their owner-occupier warehouse or retail shop. They're just happy to be tenants because the interest rates don't make sense. People feel poorer, so that big deposit is probably less likely to be there. So the tenant market, just like it is in residential, gets very strong in a higher interest rate environment, and that has a better net benefit for you long-term, and plus inflation erodes debt. So the more inflation that happens, that X amount of debt everyone has is going to erode faster over time. So if you get past this hump, then there's going to be pretty good stories to be had in a few years' time. It's just the cash flow is hard for most people now.
Okay, so that's sort of REITs versus direct, and noting that we won't chat specifically about funds, but look, if you want to pick that chat up, I'm sure Scott and his team are happy to have a yarn with you about it. It's just one question I want to ask. What's the interest rates you're getting at the moment? Just on your stuff, lease stock or otherwise. Can you give me a sense? Because I'm looking at some of mine, going, is this competitive? And you can call up your lender with a commercial, just like Resi, going, hey, I want a sharper rate, or I'll shift it.
So my rates range from 5.6 to 6.2. The 6.2s I've recently just reached out to my broker and said fixed them, and they're coming down into like the high fives now. So
Fixed.
I
You're
got
fix them
variable.
as in, okay, yeah.
all
So
variable.
saying they're too high, get them lower. Yeah.
Yeah. So
What sort of lenders are you with?
major one is the two majors are CommBank and Westpac.
Yep.
But I've got a lot with NAB as well. So probably those three, and then a few of the smaller banks with the resi stuff. But I like going with the banks who offer the best deals of the year. So you stay flexible because you might move everything in a year's time, especially with the predicted rate cuts next year in 2024.
Yeah.
You don't want to be sitting on some fixed rate where you can't get out of a loan. Like there's going to be a lot of refinancing next year, and it's because deals are going to be there to be had, I think. So get through this year and there'll be a better picture next year.
So the point being, call up your lender and say, as a commercial investor, hey, what can you do on my rate? Otherwise, I'll refinance it.
Yep.
Yeah. I actually did some of that on my portfolio on Friday when I sort of get a bit pissed off and annoyed with the world. I go, I'm going to call up some banks and get into a fight because it just rails me. And I called up one bank, major bank, and here's a hot tip for you. Google discharge your mortgage phone number with a bank and you'll get a direct number that you'll get pretty quickly chatting with someone. And they shaved well over a percentage point off my rates in about 5 minutes across 6 loans.
What are you paying on your super fund one? Because they're quite high at the moment.
Yeah, and that's it, right? Because I was going to ask you around that because they're less forgiving on stuff inside your SMSF. It's got to be 7.3, 7.4 maybe.
That sounds about right. Yeah. Because mine's quite high. Like I've only got a small loan in the super, but
About the same?
it's about that. Yeah. So a super fund, like you're going in with a fair bit of cash in there, so it's still positively geared to get those loans. But you're not laughing to the bank on cash flow.
And they don't care. You call up going, I'm going to refinance my loan in your super fund and go, all right, good luck.
Yeah.
You know, I don't know.
There's just not enough competition in that
There's not enough competition. They go, okay, go and do that because they know there's more lenders back inside of SMSF commercial, right? But still not like that. They just go, yeah, all right, good luck. Yeah, enjoy.
But outside of super, it's
much easier.
Lease stock loans aren't as good as they were. Like they're going back to the 65%, but like they dropped down to 50% debt for a while.
Yeah.
That space will improve, but right now it's not fantastic. But the rates are probably 1% higher.
Do the banks ever revalue your assets and go, no, I'm not happy with the LVRs? Like, because I imagine their valuation might differ from a market valuation, right? Do you ever get a margin call on your stuff in commercial?
I've never had it. I always tell them to do valuations myself. So my last round of valuations were like 2011 and hadn't done anything since then. But there was a lot of growth in 2012, a lot more than the recent kickback. There's a net benefit because I'm doing it now I think there's good buying right now. So like
So you're going to extract some equity, are you, and go again? Yeah.
I'm doing a few developments because I've got shopping centres that have free land. So like they're a long-term play.
I've got some shopping centres that have some free land.
Yeah.
Okay, here we go. So you're going to be extending shopping centres now, are you?
Yeah, so one's got 1,000 square metres of net lettable area add-on. I bought the land next to it, so you could, and I got a DA. It cost me $60,000 to get that DA plus the land we bought.
Is this regional?
That one's a regional one.
Yeah.
And
the council pretty happy if you'd extend your shopping centre. They're probably going great. It's great for the community, right?
Yeah, it's all about like car park ratios, and the tenants were all freaking out because they saw it and they objected to it, basically. But we're not going to
so the tenants going, we don't want any more here because it's going to dilute people buying stuff from them.
Yeah, they voiced their concerns. But we're not going to put conflicting businesses in there. Like we want to work with them. And
how big is the shopping centre? Like,
it's 8 shops, so it's got a food works, a chemist warehouse,
like a high street type of thing, right?
No, like
a little.
Yeah, it's next to an airport, regional airport, and like with that centre, it'll add 50 car parks and 3 more shops, big ones too. So
you're going to put an Audi in there. Is probably what will annoy the food works, right?
Won't do that one.
No,
but probably some I don't know. Yeah, there's just so many variations, any of that kind of, I guess, business, food-related stuff. We don't have much of that in there.
Put a KFC in there. Yeah. Can't go wrong. But anyway, I've jumped in a lot of my questions. So let's get back to the questions here. So this one here is around sort of value adds. I won't go into the whole sort of extracted thing, but value add frameworks for extracting all the value of your commercial assets. It's a bit vague, right? So pretty much, what are you got to do to get more value out of what you got right now? We've spoken about this before, like chucking solar panels on your roof and renting that out. Yep. You talk about maybe if you can put some signage on there, if you got somewhere on a thoroughfare, you put some signage on the side of it, and you can sell that to someone. So these are all the little, probably 1%, 2%, 5% where you can eke a few more bucks out of your commercial asset, right?
Yeah. So the highest percentage play, the one that you'll actually action without dumping hundreds of thousands or millions of dollars, is raising rents and lengthening leases. So this is the perfect environment, the best environment we've ever had since I started investing to raise rents, because rents are going up, particularly in industrial. Some tightly held retail is going up very quickly. And
but you can only do that at the point of a lease renewal.
Yeah.
Right, it's a lot more static than residential property. You might only wait 5 years.
You can go to the tenant and say, do you want to renew early? 100%. Like, especially, like we did one with a gym recently. It was 3 years out, and the guy wanted to sell his business because he wanted out, but he needed a long lease to increase the business valuation for that gym. Then we got a 10-year lease out of it. So we turned a 3 into a 10. And you just
so he can sell the business on the continuity of the lease, as in it's not going to go away. So he was happy to sign on for a few more bucks.
Yeah. So imagine you're going to buy a gym and you saw that there's a 2-year lease left. It's a question mark, and you'd worry about it. You'd naturally think, well, I don't feel secure, because what if that landlord didn't allow me to renew? There was no option on that. So yeah, it's a question mark that would hurt a valuation for a business.
So that's how you can increase the sort of extract more of the value of commercial asset is longer leases and higher rent.
Yeah,
before you start getting to the other stuff.
But be careful with longer leases, because this changes over time. Like, I was talking to a client, we're looking at a 10-year lease on a big industrial property in Brisbane. That sounds amazing. Everyone wants a 10-year lease. But we got through it and we were like, well, actually, this 10-year lease is going to hold the value back for quite a long time, because rents are going a lot quicker than...
And what's a set sort of annual sort of increase?
4% increases.
Yeah.
But 4% increases when rents are going double that doesn't look great.
No.
Especially for 10 years. So we would actually have preferred a 3-year lease in that case, even though the bank wouldn't like it as much, most investors wouldn't like it. But if you really think the value add side of things, that rent going up and the ability to tweak it earlier is a big advantage. But just remember, like, these valuation uplifts, like they're still there for a rainy day. Like, even in that 10-year example, like, there's going to be a lot of upside in that rent eventually. It's just not in the next few years. So,
well, 4% compounding, you do the math, it starts looking a bit attractive, right, over 10 years.
Yeah.
Big time. Yeah, it does. And there's another question here, which is around lease renewal time. Well, we're talking about how to extract the value of a commercial asset. But I imagine the same thing applies, right? How soon before a lease expires should you start negotiating with a tenant?
I personally like letting it lapse, which won't suit most people. But
so you let your leases lapse?
Because it doesn't give them time to play the market, call around. Like, a lot of them will do that anyway, but you'd be surprised how many tenants just sort of let it go and just, then they don't do the homework, and you just come to them and say, here's the new lease. Look, here's a spreadsheet full of all your neighbours' rents. They're all 20% higher. We'll give you a deal at 10% higher, meet you halfway. But if you do that 6 months out, from a negotiation point of view, it can come across a little bit desperate. If you're like, oh, quick renew, please, come to me. They're going to be like, what's in it for me? I can get something out of this. If it's lapsed, like, they're probably not thinking, there's a less likelihood they're going to think like that. So it's not good for everyone, because people want security. But, like, especially if you've got a multi-tenant investment, there's safety in numbers. If one tenant, goes vacant, it's not the end of the world. So the accumulation of better negotiation can happen when you're not desperate, because you're just going to be from a stronger position.
Yeah. Okay. Well, that's a hot tip there. There's another one, Scott. What do you do if you've got vacant property? So I guess it's sort of connected with it. How long, if they walk, a bit of brinkmanship and they walk, what do you do with your properties vacant? I guess it's a good time to maybe spruce it up a little bit.
Yeah. Well, look, we've got a lot of experience because, again, we've helped thousands of clients. So obviously properties go vacant in that period, and it's never really a disaster ever, because especially when you're buying a well-placed property, and the tenant market's pretty good at the moment. I actually sometimes get excited by those opportunities because, first of all, you've got to find out why it goes vacant. And I like getting multiple agents on it, and just be prepared for, you can get 3, 4, 5 months vacancy out of it. But remember, your next tenant will probably stay 5 to 10 years as well. So vacancies in commercial are all going to happen at once. Residential, you're going to get annual vacancies. That all adds up to, maybe 40 weeks in a 10-year period anyway. You might get half of that all at once in commercial. So the vacancies can hurt when you're in the moment, but if you work with good managers, then you fill them and you spruce them up. Every property will be different. Like, you've got to really go through the make good provisions to the last tenant. So as soon as your tenant goes vacant, get your lawyer to look over the lease and just see what is in there in terms of the bond and what they've got to do with the rehab of the property.
Yeah. And I guess it could be an asset, right? Because if you do need to spend a few bucks on the place, often you're better redoing a lease and you contribute to that as part of the lease negotiation. So you keep your rents high. If you say, hey, it's X number of square meters and we'll give you 300, 400 grand to spend on fixing the place up. That's all a positive for the owner because you can depreciate that. You own the fit out. You can depreciate the fit out, and you can keep the cash component of it high. So if you're going to do it anyway, you may as well get some value out of it.
Yeah,
these are the games.
And one of the things that one of my pet hates as well is a lazy agent. And I'm not saying they're all like this, but an easy default move is to drop the rent, especially if it's vacant for a couple months, and that will really devalue your property over the long term. So I always say to your agents, like, if I dropped it $20 a square meter, is that instantly going to open me up to a new pool of investors, or are you just dropping it because you think it's something to do? It's amazing how often because I get called up and the clients say, oh, they told me to drop the rent. I'm like, on what basis? What's the reason? Are there tenants waiting? Have you got offers at that lower amount? Because if you're just dropping it for the sake of it, then again, that value for the next 5 years is just going to be artificially kept lower. And sometimes an extra few, but like, you need patience and time in the market for that random tenant to come up. Yeah. And they do come up. Like, I've seen it hundreds of times, and you just got to just grin through it and deal with it, and then luck happens, and then you've got that tenant.
Don't sweat it.
Yeah.
Don't sweat it. Here's a good question. How close should you get to your tenant? So I guess that is like, do you want to have a relationship with your tenant? I imagine there's probably more negatives than positives, right? Oh, sorry, Phil, I can't pay the rent this week,
Yeah, I've never been close to him. And look, I know some very great, like real good professional investors that do the opposite. So it's personal choice at the end of the day. If you're retired, a lot of my clients are retired, so they've got time, they get in the caravan, they can see their properties, they love it. It's a hobby. It's almost
so they're like great nomads that drive around Australia looking at their commercial property, like park in a car park in their van and get their mower out and cut the lawns.
Literally, 100%. Like one guy, like he had this big industrial property and he did the garden out the front of it, just wanted to do it. Had pride in the property. No one else in the shed probably even noticed it, but it's something to do. Like, you do have pride when you buy a big trophy asset or even a small one. So everyone knows that through buying a residential house. You're kind of excited about it when you first own it. Then 5 years later, you forget you got it. It's just it's a cost center or cash flow center. But people will manage tenants in those cases. And look, my problem is if you get cozy with a tenant, they'll get slack with paying, and you do need to involve a lawyer to send that 14-day breach notice. So if they're late, don't let that habit continue, because it's a very hurtful habit which can, it can really get out of hand. So lawyers will come into it and it cuts it out most times. So you're not going to be the best friend in those cases. Just arm's length, good manager in place, and you can do everything you could do self-managing, but arm's length.
Yeah, it's important. I think you're better off being at arm's length rather than otherwise. Otherwise, you get compromised. It's the biggest capital injection you've ever seen in a commercial property.
Oh, look, I know I'm negotiating. This is not the biggest, but we're negotiating on one now. There's there's about 900 grand of air cons that we've got to fix up. And the owner, like, this is a live deal, but the owner basically doesn't think there's anything wrong with it. So you can see like aircons can be huge capital that works. I know shopping centres, like especially the ones the big fund managers manage, like they can be annual several hundred or million, like $3-4 million a year on a deal. You've got to basically plan. It's part of the ongoing program.
Like clapped out elevators and lifts and stuff, clapped out this, that, and the other.
Yeah.
Yeah.
And it's all factored in the numbers. Like, so you normally, like a strata report, you know how they got like a 10-year capital works program. Like that's what you'll need to do if you start owning lots of big properties. And then you can basically make it into the maintenance program and kind of factor it in the outgoings as well as a non-recoverable outgoing. So you could still include it as the yield. You know,
so you actually get it factored in so the tenants pay for it?
The tenants may not pay for it, but if you go sell the asset or you're buying the asset, more importantly, you got to look at the rolling capital works program and take that off the numbers because otherwise you're going to get a false economy.
Okay, because you're going to have to pay for that, right?
Yeah.
Yeah.
Yep.
So new air conditioning is expensive.
Yep.
Lifts are expensive. So buy shopping centres without lifts, I imagine you say, for some more mum and dad investors.
Yep.
What about industrial? You don't really get hit too hard, right, with industrial stuff. There's less moving parts that probably need fixing, right?
Yeah, like the walls generally stay for most of our lifetime. The roof might go every 10 to 20, 30, sorry, not 10 years, probably every 20 to 40 years, depending on the climate. They're probably the biggest cost you'll get in there. Outside of that, it's like power upgrades and, you know, you might have a big crane and stuff like that. A lot of it could be passed on to the tenant as their responsibility rather. And the costs for those can actually be incorporated in the rent. So if you've got like a big gantry crane in there, that means the tenant will have to pay more. If you're the owner of that, the tenant pays more per square metre for the rent. So you'll get it back one way or the other. So again, these are the little things that it's hard to pick up the first time you do this. But yeah, if you do your due diligence properly, you can get across these potential unknowns pretty easily.
Okay. So another minute or so for another question. So there's a bit here, but I'll just be specific. One of them, it's questions here around negotiation of commercial property do's and don'ts. And they're sort of specifically asking a point here around negotiating on pest and building reports. How do you suggest you deal with it? So I guess a pest and building report's a tool for trying to get a cheaper price, right? Is probably how you guys use it. You want visibility of what is the state of the property, and we spoke about sort of biggest capital injections, and hopefully a pest and building report would find out that you got knackered air conditioning. How do you use pest and building reports?
So this is a big part of my daily job because I'm the one sort of personally negotiating a lot of properties for our clients. So building and pest tends to be the biggest item, or maybe just differentials in outgoings but that can be all related back to building and pest. But the strategy that I use is, well, number one, you've got to get your building and pest report and aircon.
Two different things, right?
Yeah.
Yeah. Some guy does a building report, some guy does the pest report. You don't get the same person doing the same thing.
Very rarely do you get pest issues in commercial because it's a big concrete structure. So that's probably more of a housing thing. But you still get it. But the issues will be in the roof, the air cons, the structural issues and stuff like that. If you're buying shopping centres or we did one that had a swimming pool in it, like because it was a gym, and under the grout had all eroded through, so there was several $100,000. And the way to do it is, and most buyers agents would know this, you basically get all the evidence and quotes and position it back to the vendor and say, this is not me trying to gouge the price. I'm not winning out of this. If you agree to this price, let's say you're asking $500,000 off a $5 million property. If they agree to that $500,000, you are not winning. You're literally just getting back.
Spend it.
Yeah, I'm spending it after settlement. If anything, I'm losing because I've got something more to manage. And they might kick and scream and go, that's a ridiculous amount. But then you make the agent aware that, because they've got the duty of disclosure as well. So they can't just, brush this under the carpet and then sell it somewhere else. So this will follow the owner around that big maintenance bill until they're able to accept it's their responsibility, or, if they're, maybe you'll get a cash buyer that doesn't check anything, and that's unethical in my opinion. They should always disclose there's issues. We've got live quotes. So just explaining all that to them is how we get discounts, and then offering an unconditional contract. So, if you've got a deal and you're asking a big discount, you've got to be prepared to complete the deal on that, so that you're not open to further negotiations. And And that's
It's really tactical, isn't it? So how many, when you're doing this, how many people are selling because they know they've got a big bill coming up as a catalyst for sale?
I don't think it's that so much. Like it possibly could. I think we know more about the property than the sellers once we've done the due diligence because they haven't got live, up-to-date, aircon maintenance reports. Like they haven't done the big dive. Like they're obviously gone out of flavour with the investment or they need their money somewhere else. So I don't think much of that goes on. It's more just unaware guys who haven't spent much on a property for 10 years and then you get into it and they're like, oh, crap, there's a lot in it. And then the bill looks horrible to them because we're dealing with big numbers. These aren't 10 grand maintenance bills. Yeah. These are,
hundreds.
Hundreds. And we've done ones in the millions where you literally, but like it's all justified and it's backed up with evidence. And again, we're not having a win here. We're just trying to get it back to square one.
Yeah.
And then we're going to deal with it after.
Well, it comes down to buyer beware still, right? If you buy it, you've got to be responsible for what you buy. So you need to make sure at the front end you're getting the right information. What's the biggest sort of pest and building bill you've ever seen on that basis? Like if you've got to go down and do that and do, air conditioning assessments or engineering assessments, if you need to do all that, like that can add up, right?
Yeah, well, we saw like a 5,000 square metre medical centre that was sinking. That was just too far gone, that thing. But that would have been a few $1 million to fix.
So it's just stuffed. Like you're not going to sell that to anyone.
No, and I know that property. I won't mention it, but it's been for sale with 5 different agents for at least 5 years. They're just going around in circles. Like I don't think they got the money to fix it themselves. And then everyone, it goes under contract and then out, goes under contract.
So someone just goes, that's too much. Yeah.
So they're pretty rare. Like a good thing about commercial builds is the specs are pretty high. You've got very good operators building this stuff. So I think the variations are less compared to someone who's just building a 4-bedroom house in the suburbs. So yeah, big expensive builds tend to have a lot more engineering. Basically they're over-engineered essentially.
Yeah, it's good. Well, we covered a lot of ground there, Scott. It's good to do a Q&A. Keep them coming. How do people send questions? What's the best way to do that, mate?
All these questions came through info@rethinkinvesting.com.au. Let us know what you're thinking. Like the next few, we've got a few big ones coming up. I want to explore the Tasmanian and Victorian economies pretty soon.
Okay.
Heard we had one of those guys that, similar to advisors, government, come into our office, and I look at Tasmania, for example, completely different. It's an incredible economy down there.
He come and sold you up on Tasmania, did he?
It worked.
Where did he say invest in Burnie? Burnie's the place to be.
Oh, it's almost everywhere down there. Like 100% renewable economy. Like it's the economy is not subject to droughts or like the agriculture is almost.
It's a lot more consistent.
Investors like the lower risk. There's a lot of Asian money going down there. There's expensive. There's just all sorts of good things happening.
They buy cheese factories in King Island. Is that the place to be? Have you been in King Island?
No, I haven't.
That's cool.
Yeah.
I don't know what it's like to invest in property there. I can't remember the little town, Curry. Maybe Curry is the capital of the King Island. Yeah. If you're going to go to Tasmania, mate, do yourself a favour.
Yeah.
Get up there.
Head out there.
Have a look around. It's cool.
Well, they got some of the world's best whiskey and great wineries and all sorts.
So you're saying invest in whiskey distilleries in Hobart? Is that what you're saying?
Yeah.
Is that what you're doing?
Oh no, not whiskey. We just like the classic industrial and.
You're going to get in there. You got any Tassie stuff?
No, but I will one day for sure.
Yeah. Okay.
Probably next round I'll look at it because it's one. Like CommSec said, it's the strongest state economy 11 out of the last 12 months. So it's something that's going on down there.
It's the only place with still a Liberal state government by memory, isn't it? It's a little island of blue down there.
Yeah. Well, they've changed the economy down there from an old world. I remember when I was growing up, my perception of Tassie was coal mining and like just a big dirty industry, like backward type place. But now it's all renewable energy and like tourism and just like techie type stuff.
I've been down there for years. Maybe we should take the show down there and we can do a inside commercial property from. Was it the Mona? Is it the Mona down there? The big art gallery,
or one of the big breweries down there.
Yeah, down through the Frasier Peninsula is really cool as well. So I know Resi property's done really well down there. I don't know if it's sustainable though. Like it can't grow too much more, but whether or not there's legs in.
Well, I think Hobart was one of the best cities over the last 30 years, wasn't it? For growth.
Performed well.
Yeah.
It's still relatively cheap, right?
Yeah.
But, Anyway, do you reckon it matters when politics and change? Was it the WA Premier resigned about a month or so ago? Does it really make much difference to commercial property when stuff like that happens?
Oh, look, it does. Like, there's obviously been some changes in Victoria for the negative with extra taxes and stuff like that. So that will discourage investment in certain areas. So, yeah, look, if it depends on what policies they put in, but I find the ones that sort of enable the economy to move forward, it's good for commercial investors. And look, what's happening in WA, it's such a strong economy too off the back of all the minerals and the mining. So there's not much that can slow that down until China decides to
Stop
slow
buying
down.
stuff.
So China affects that probably more than whatever politic.
Well, maybe we can have a chat one day around geopolitics and commercial property, right? You know,
well, that's what you've got covered. That's your domain.
Oh, maybe. Anyway, well, thanks, Scott. That was really good. Long one, 50 minutes or so. I hope you enjoyed that, everyone. Get those questions coming in, which was info@Rethink Investing. I get that right? Questions.
Yep. info@rethinkinvesting.com.au.
And is that, if people want to have a chat with you guys as well, that's the best place to find you and reach out?
Yeah, no, we're actively buying all over the country. So if anyone needs a hand or just wants a second opinion on commercial property, happy to help.
Where's the most regional place you've ever bought a property, commercial property? Just final question.
Probably some of the small towns in southeast Queensland, like out Warwick or bought in Chinchilla before.
Chinchilla?
Yeah.
God.
But you just buy something right on the main street, long lease. The yields are incredible, so you just got to...
You only invest in areas that has an airport that takes Qantas planes, right? Is that pretty much your investment profile?
No, we're all over the place.
Follow the airports.
Yeah.
Follow the airports. Nice. That's Scott O'Neill from Rethink Investing. Reach out to these guys, touch base with them. They're just happy to have a chat with you. That's what you want to do. info@rethinkinvesting.com.au. I hope you enjoyed that, everyone. Thanks for joining us. We'll be back again next time. Until then, bye-bye.